Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
We're talking about Boeing. Shares of Boeing once again hitting some turbulence, down more than 3% as we speak, down more than 4% at its lows today, but right now about a 3.2% loss. This is after the U.S. Justice Department opened a criminal investigation into the mid-air blowout of a fuselage panel on a 737 MAX 9 in January, something we've been talking about when it comes to Boeing all year.
And just yesterday, U.S. Transportation Secretary Pete Buttigieg said the FAA will rigorously assess Boeing after the blowout of that fuselage. Meantime, the head of Delta Airlines telling Bloomberg on Sunday, Carol, that he expects further delays of the yet-to-be-certified 737 MAX 10 variant.
All right, now Boeing shares for the year, as we said, under pressure. They're down about 30% year-to-date. Meantime, for a little contrast here, folks, the ADRs of Airbus, Tim, they're up about 11% year-to-date.
Well, you bring up Airbus, Carol, because Boeing's stumbles and struggles are an opportunity for its lone major competitor, and that, of course, is Airbus. That is the topic of a story in the current new issue of Bloomberg Businessweek. We have Businessweek's assistant managing editor, Jim Ellis, joining us here in the studio. Jim, good to see you. Thanks for joining us on this. A great story that's in the current issue of Bloomberg Businessweek. To what extent are Boeing's troubles gains for Airbus? Because we know that these airlines, they don't necessarily have a ton of choice when it comes to what they're buying. Their pilots are trained on certain equipment. Their maintenance crew are trained on certain things.
It's to change aircraft makers is a big deal for an airline. But we've gotten to a moment now where there's so much. There's a lot of bad news. There's a lot of questioning about the quality of Boeing's equipment right now, that it comes at a particularly bad time for Boeing, simply because a lot of people are starting to think, a lot of airlines are starting to think about the next generation of aircraft. And, a lot of people say, well, things are happening now. Everybody's going to jump and run to Boeing. Run away from Boeing. It's very difficult to do simply because, as you said, your crews are trained on that, and you've made these multi-billion-dollar investments. But what's at stake here is the next generation of planes. What happens is that because in the airline business you can use a piece of aircraft for decades, you don't make these decisions to change lightly. So instead, it's time to think about the next generation. And so what Airbus is doing now is they're going to have some room to go ahead and say, I'm going to come up with a new plane at a time when Boeing is so, sort of troubled and so consumed with thinking about how can it deal with its quality problems, how can it also deal with its balance sheet problems. I mean, Boeing is in the point right now where it doesn't have a lot of financial flexibility to build a new plane. And so Airbus, however, is probably about a $50 billion advantage over it from a debt standpoint. And so they can move ahead and start planning for the next generation and sort of seal this dominance that they're probably going to have of the aircraft business.
Jim, tell us how fortunes can change. And I love how the story starts. And you guys go back to 1987. If we can all remember back then, it's a while away. But talk about what happened and how that maybe set the stage for where Airbus is today.
Yeah, I mean, what happened is a lot of people thought when Airbus decided to bring out its A320 narrow-body airliner, that people thought, how are we going to do that? I mean, we've got the 737. The 737 rules the skies, and they come out with this A320. They have a great party. They have, sort of Prince Charles at that time, or Lady Diana. I mean, it's big deal. Fireworks and everything, and everybody says, that's not going anywhere. You cannot beat them. And at that time, Boeing had 10 times as many 737s popping out than A320s. Fast forward to today, and the A320 has become the best-selling commercial aircraft of all time. Mm-hmm. I mean, that's a big deal, given that Boeing had commanded that market for so long, and the 737 has been a major player in aircraft for almost a half century.
How much of that is the mistakes and problems that Boeing has had? How much of it is it just folks started to kind of really like the A320 and shift their ordering book?
A lot of it is that the A320 just sort of came in with a lot of innovations that, customers connected with. What they call fly-by-wire, the sort of joystick, sort of all-electronic cockpit, the idea that it was a slightly larger plane, which then set off this whole thing of continually making these planes bigger and bigger and bigger and bigger.
I meure how big my seat is. I don't know about you guys, but I do.
It turned out that they were in the right place at the right time, but they were also extremely, because they didn't have an older model that they were basically just retrofitting, they could think differently. They sort of took it and they ran with it, and now they're in a position to think about the next generation of airplanes that can, fly on sustainable fuel, that can do all sorts of, sort of electronic things in the cockpit, but also can take structures of airliners in a different way. They're planning a plane now for this next generation that has a wing that's shaped like a bird's wing, that can actually change its shape in flight. And also because airports weren't built for these new giant planes that we're building now, they're going to have aircraft with the wingtips that fold up, so you can still put it in the same place, but and then when you pull it away from the onto the tarmac, flip the wings out. They are basically taking advantage of what they have right now, which is a lot of money, as well as not the look of all the stock market saying, "Oh my God, you're a terrible company," which is what Boeing has to deal with right now.
Well, just like in the late 1980s when Airbus was the upstart against Boeing, now there's another upstart out there that should have what, for practical purposes, is a duopoly between Airbus and Boeing, but may not be forever. Enter what China has.
Comac. China's aircraft company, which a lot of people in the West don't know because it has only so far built planes for Chinese carriers. But the thing that remember is that Chinese carriers have become major purchasers of Western aircraft. Most of the aircraft, flown by the big three Chinese airlines are, Boeing or Airbus. And however, a big percentage of the order books for these American and European companies come from Chinese airlines. Now China has decided it wants to be a player in the aircraft business. It feels like, why are they giving all this money to the West? They want to basically be able to, they want to take that duopoly and make it into a triopoly. And that has got to be a frightening thing for Boeing especially. Can
they pull that off outside of China, in that would regulators in the U.S. and Europe foreseeably approve these airliners?
That's the question. And part of that is safety issue, part of that is just engineering issue, and part of that is a political issue. In the sense that, can China build an aircraft that flies? They're doing it now. They're doing it for Chinese airlines, and they finally have gotten a non-Chinese airline, though it's Tibet Air. But then they are also marketing it now to Western aircraft. And they will find some sales there, but the issue becomes one of whether they want to take more of their own carriers and sort of persuade them to buy Chinese. And if they do that, that takes away a lot of the sort of extra stuff in the order books of the Western aircraft makers.
I think what's so interesting, too, is you don't have Airbus coming out and being like, snap, we've got this all down, because A380.
Right. They understand that you got to be very careful to sort of make fun of somebody else having a problem, because people will just turn it around and say, well, you've screwed up before. You made the A380, which sounded like a great plane. Passengers loved it. Double decker, it's really cool. The issue was it was too late. It came to the market at a time when people decided, when airlines decided, we don't need a 550 seat aircraft to take people back and forth. Instead, we want smaller aircraft that can take people on what they call long, thin routes.
Fuel efficiency.
That's it. And 4 engines. That plane had 4 engines. That's a lot of fuel. And so instead, 2 engine is what people want in wide bodies nowadays. And so that plane lost money.
That brings us back to the narrow body 737 A320, which is certainly the bulk of the market.
Yeah, that's the workhorse share of the airline market. It's where 80% of the planes go. And so you will either succeed or fail based on how you do in the narrow body market. And the reason that Airbus was able to sustain basically a losing program in the A380, that ended years before they had planned it to end and didn't make any money for them in the long haul, is because they made so much money on the A320, because the narrow body market is the bread and butter of flying. And if they can figure out a way to command the next generation of those and not split that market with Boeing, then they could have dominance of that market for years to come.
At the same time, Boeing can think about its way out of this is to be dominant in that, in kind of the next wave as well, right?
Well, that's
to grab the talent and the engineers.
That's also the counterintuitive thing. A lot of people say, why should Boeing just say,
I'm done.
I'm done. What maybe Boeing can say, I don't care that I don't really have the money to pursue a program. Maybe I should go ahead and do it now because I don't have that big of an order book. I mean, it's very difficult for Airbus to do anything very quickly simply because it's sold out in its current A320s all the way through this decade into the next decade. It's so popular.
It's great visibility, but it also kind of handcuffs
It handcuffs you because basically you can't walk away from a winner.
Great stuff, great history into kind of understanding what really is a duopoly when it comes to airplanes. Jim Ellis, as always, we so appreciate it. Assistant Managing Editor at Bloomberg Businessweek right here in studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Now, folks, we're pretty much done with the earnings. We had a little bit of names trickling out last week, but you might recall from the earnings wrap-up how Meta is still the king of digital advertising. The social media giant overcame grim expectations for its advertising business, in part due to high spending by China-based advertisers and AI-generated video content. Users on apps such as Facebook and Instagram spent 25% more time watching videos. So it's a thing, Tim.
Ask anyone who uses any of these apps. Of course it's a thing. Well, companies including Meta Platforms, Amazon, Alphabet, and many more competing big time when it comes to the space. Our next guest has a unique window into the digital ad space. So let's get to the interview. With us is Mark Zagorski, CEO of the publicly held DoubleVerify. It's a $5.5 billion market cap company. It does application software and digital media measurement. Customers of the company, Carol, include a who's who of corporate America. You got Colgate-Palmolive, Ford, Mondelez, Netflix, TikTok, Twitter, and more. That's according to the Bloomberg supply chain function.
Mark, so great to have you here with us. First up, so everyone understands your chief business, kind of lay it out for us, because you do work with a who's who of corporate America.
Yeah, so it's great being here. And as you noted, we work with some of the biggest brands on the planet, and what we do is we help them ensure that their ad spend is delivered in a brand safe environment, that it's actually viewable by a human and it's not fraud. And that those transactions are secure. So think of us as kind of advertising security software, but we see across social, across the open web, across mobile, across connected television. If there's some place that has ads, we're measuring or verifying across it.
How do you know if something is brand safe or not?
So we look at a lot of different factors. So if it's video, we can look at the actual video that's running. We can listen to the audio track and analyze it. We can look at the context or metadata around it. So we basically look at all of different contextual clues that we see. And we do this in real time, and we're able to report back to our advertisers whether or not their ads are running environments that are aligned with what they want their brand to represent.
A lot, Mark, has been made over the past year or so about what's happened to the company formerly known as Twitter, X, of course, and the way that the content on the platform has changed. Is X to you still considered brand safe?
Really, we look across all the different social platforms, and, we make a call, we categorize content. It's up to our advertisers to determine whether or not that content fits what they consider suitable or safe.
Does it seem like the companies are now saying it's less safe than it previously was?
We have seen more advertisers move away from Twitter than move toward it, or X. But there are still advertisers who are putting a hefty amount of spend against it. It's about really threading that needle. And X has worked with us in a really positive way in saying, let's give the advertisers the tools to be able to slice and dice the content the way they want it.
Well, in terms of platforms that are out there, we mentioned Meta, but you got Alphabet. Where is it that you kind of see clients most likely to put out some kind of digital ad, if you will, and link it to their brand, obviously?
Yeah, so we see social, and I think you just mentioned earlier video. Social video is really eating up the internet right now. About 70% of social engagement now is with video. Short form, things like Reels, YouTube Shorts, TikTok, they're exploding. They're eating up a significant portion of consumer time, as we know, and that means that's where advertisers are going. So, we try to verify all transactions, whether they're open web, social, again, CTV, but we're seeing more and more of those advertiser dollars and, heading towards, short form social video.
Like TikTok?
Yes. Yeah. TikTok created the revolution, but Reels and Shorts are really part of it as well now.
But I do wonder,
Yeah, go ahead,
just
Carol.
to follow up, though, on what Tim brought up about some of the concerns around X and whether it's TikTok, between certainly U.S.-China relations, that these companies, increasingly Chinese-based companies, are on regulators and policymakers here in the U.S. on their radar. Do you continue to expect that to kind of play out here? And what does that mean then in terms of some of your clients, where they're going to choose to kind of put their ads?
Yeah, I mean, there's no doubt that advertisers want to be where consumers are, right? And if consumers can't go to one platform, they're going to go to another. Consumers love short form video. So if for some reason a platform loses favor because of government regulations or any other reason, the advertisers are going to chase those consumers. So, the beneficiaries of a TikTok, ban in this country is going to be Facebook and Google, no doubt.
Do you think it's realistic that the U.S. could possibly force ByteDance to divest?
That's a question above my pay grade. I would never want to try to discern what's going on.
But is it on your radar, like this is a real risk to not just to your business, but to the space?
I mean, I think, for the first time, this is probably getting a bit more serious than it has been in the past. Advertisers are pretty nimble, though. If anything happens on one platform, the beauty of digital is they can move very quickly to another platform. I mean, they're looking for engagement and they're looking for deep engagement, and social video provides that no matter where it is.
Where's the best engagement right now?
We don't look at kind of time spent on each platform, but we know where dollars are being spent, and dollars are being spent, pretty heavily across all the three that I mentioned in short form video. So across Reels, across YouTube Shorts, and across TikTok right now.
So another way to ask that question is who's struggling right now? Where's the money not going?
I think you're seeing more and more dollars move away from open web into more walled gardens, more social, into retail media networks, which are really benefiting right now. So, powered by folks like Amazon, Walmart, Kroger, Macy's. This is an entirely new emerging area where advertisers, love the data that those retail media networks produce, and they're able to see kind of a really strong closed loop performance environment.
What's top of mind as we get ready for the November election cycle? I mean, it's off and running and we know it's underway. And I mean, I'm curious about what is the balance, if there is one, among a brand, a company with high recognition that's looking for the clicks, right, in terms of people viewing their ad, but at the same time not necessarily wanting to be next to questionable content or, content that's going to either amplify potentially things that they would rather not be associated with.
Yeah, it's a great question. I mean, political season always brings up a relatively challenging environment for advertisers. They certainly want to be around where people are engaged. People are engaged with political content. There's no doubt about it. However, there's definitely topics that they don't want to be associated with. And, as recently as earlier this year, between January and February, we saw a 22% increase in hate speech, for example. And that's just starting off the year. So we know as the campaign gets more and more heated up, we're going to see more instances of what we call inflammatory news and political content. And that's things like cyberbullying. It's things like hate speech and misinformation, disinformation. So that will heat up. And hopefully what we're able to do is give advertisers the ability to avoid some of the content that they don't want to be around, but still be part of the news engagement, still be part of the stuff that folks think is important, without having to, avoid news or relevant content altogether.
Yeah, it's complicated. Hey, listen, Mark, I feel like we covered a lot of ground, but also scratched the surface in some ways. So hopefully you'll come back soon. Mark Zagorski, CEO of the publicly held company DoubleVerify. Stock, by the way, down about 12% so far year to date, but trending a little bit higher in today's session.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Reddit disclosing further details of what is set to be one of the year's biggest IPOs, with the company and some existing shareholders seeking to raise as much as $748 million.
Reddit and the holders are planning to sell 22 million shares for about $31 to $34 each. That's what the social media platform said in a filing today. About 15.3 million of those shares will be sold by the company and the rest by investors who are Reddit employees.
It's been quite a slog, though, to get to this point. So let's get to it, and keep in mind that what Tim just laid out, at the top of the range, Reddit would have a market value of $5.4 billion. So that's a real market cap, if you will.
Yeah, let's get over to Amy Orr. She's Bloomberg News Equity Capital Markets reporter, and she's here in the Bloomberg Interactive Brokers studio. Just for context, Amy, Snap is about a $19.5 billion company. Meta Platforms, of course, much, much bigger.
Is that really apples to apples there?
But look, it is, because these are both supported by advertisers. And like we spoke to earlier in our program, the bulk of the advertising money is going to these short form videos.
Yep.
And then here comes Reddit with essentially a technology and a product that is, at this point, almost 2 decades old, hitting the capital markets.
Yeah, but then a lot of people are looking back at Reddit and comparing it to Meta when it was still Facebook, when it first listed on the US stock market. And then that was the time when it was about to go profitable. And then this was the time as well for Reddit as well. So there are some comparisons, but it's also it's interesting too.
Okay, I just want to point this out. Meta Platforms, now the company formerly known as Facebook, was started in 2004. Reddit was started in 2005.
Yes.
So they're almost the exact same age. So it's hard for me to make that comparison that this is Facebook, pre-IPO.
Yeah. So here's what I'm interested in, Amy, is what is the business that is Reddit? Because Tim, didn't you say you're back in Reddit?
I'm in Reddit for the first time over the last few months. I find it
So you're too late for the direct share sale.
I'm telling you, too
But
late.
you bring it up in the newsroom and people are like, oh yeah, I'm on Reddit. People go to it for answers, right? Or to find forums and like-minded people
it's
who they have
crazy
questions
niche.
about.
It's super niche. You can find plumbers to help you with plumbing.
Right.
You can find drywall people to help you with drywall. It's crazy.
All right,
yeah,
so
a lot of people are sticky users of the platform as well. But then it's also funny how half of the users do not have a login. They also, like me, I would not go onto Reddit on its own. I Google it, and then it will lead to
what I do.
And especially because Reddit has a lot of original content. So like Google with its SEO and all will really direct traffic over.
What's SEO?
The social
search engine optimization.
Thank you.
Is that helpful to Reddit's bottom line? Carol and I were going through the S1 earlier. They said we get substantially all of our advertising. I think is the exact all of our revenue from advertising.
Yeah,
that's tough in this day and age.
It is tough, but also it helps and not helps at the same time, because while it benefits, there are also periods when Google or Facebook or other places where essentially it will lead to Reddit may change its tools and the parameters, and then that might hit. So it's good and bad, but also the company is diversifying itself outside of advertising. So at the end of the day, the company CEO said everything on Reddit is at the end of the day linked to buying and selling a lot, whether it's people actually shopping for new running shoes. Yes, but search for things that will lead to advertising. So if you're buying a new pair of running shoes and then you want to see which model fits a long distance running better or anything in particular, people have really niche, as you said, niche needs for things, and then they will go to Reddit. But it's also the company is diversifying beyond just advertising.
What does that look like?
It's selling, licensing some of the data that it's been doing for 20 years.
That's what I find interesting in your story. Reddit saying it's in the early stages of allowing third parties to license access to data on the platform, including to train artificial intelligence models. So is that what it's going to be all about? That they have a lot of people like Tim and others who are spending some time there, sharing their data. That's valuable.
that's very valuable. And especially, it's not only just for Google, for AI to learn, but also for companies, like to actually see what is the trend, or hedge funds to see what people are talking about. Like, so there are many uses of those data, but whether they can capture.
Is that a business?
Well, they got 60 million for a 1 year runway with a deal with Google. So it's actually, a pretty penny.
Twitter used to do this and make money through selling the fire hose of data. And I don't know if they're still doing it. It's a private company, so it's hard to know. But this was a big selling point of Twitter back in the day that was like, hey, we have real-time information. They would actually sell to news organizations.
That makes sense.
And they would say, okay, well, we have people all over the world who are monitoring what's going on the ground. If we see signals of some breaking news event, we can get that to you before other people know about it.
Well, I'm glad you brought that up, because that's what I was, Tim and I were talking in the newsroom about this, Amy, and I'm trying to say, is it like Twitter? Like, we all loved it, or love it, maybe still, X, and found it really useful, certainly for those of us in the news industry, like to find information, and yet the business model has struggled. Is that the same story for Reddit?
It's or
similar.
Like you said, it takes 18, 19 years for it to become profitable.
That's a long runway.
That's a very long runway. But then at this particular point in time, there are a lot of tailwinds. So it's really up to the investor whether they actually believe in the growth going forward and not looking back and saying, you take so long.
What does it say about the IPO market that this could be one of the year's biggest IPOs?
So right now, the IPO market is still pretty subdued. So far this year, only 7 billion raised. This is already March now.
So big fish, little pond?
Well,
little fish, big pond?
And then we also had one of the best few weeks in ACM market, just secondary share offering, block trades, convertible bonds. Those were huge. And IPO hasn't actually benefited that much. So hopefully this will get people talking and then create that buzz. And I guess Reddit wants to create that buzz with a direct share sale as well.
Remind us, ARM's IPO was almost $5 billion.
Yeah, and then it went up 140% since then. So
okay, so 700. It is, but I'm just saying, if this is the biggest IPO of 2024, then
right, some perspective.
A fraction of what ARM was just last year.
We also had earlier this year in January, there were $2 billion share sale as well. Amer Sports and also Caspi, which is just a secondary listing from UK. So it's up there, but not top.
Still a subdued market.
Yes.
Overall. All right, great stuff. So appreciate it. Amy Orr, Equity Capital Markets reporter at Bloomberg News, joining us here in our Interactive Brokers studio. Thank you, Amy.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 18 and a half minutes left in today's trading session. Carol Massar along with Tim Stenovec, and you just had Charlie breaking down the trade here. And, there's a great story, Tim, that's on the Bloomberg terminal.
Yes, which one is it? It
has to do with the Magnificent Seven, right, which is something we talk a lot about.
Are they still all magnificent?
And, well, JP Morgan coming out with a call. The ranks of Wall Street strategists playing down concerns about a bubble in U.S. technology mega cap stocks. We're seeing the play down and saying, don't worry, that's growing. Team over at JP Morgan Chase was the latest to flag that valuations of the 7 tech giants that have powered the record-breaking rally on Wall Street are currently lower relative to the rest of the S&P 500 than the average of the past 5 years.
Okay, here's what the analyst wrote. Quote, there is a concern over the very strong performance of the Mag 7, but we note that the group is currently trading less stretched than a few years ago, given earnings delivery. This is not to say that the group is immune to profit disappointments ahead, but in the case of general earnings disappointments, these stocks could still hold out better than traditional cyclicals that are reliant on the economy. This, again, not my words, not Bloomberg News' words. These are coming from the team over at JP Morgan Chase.
The Magnificent Seven stocks, you know who they are. We're talking about Apple, Google, parent Alphabet, Amazon, Facebook owner Meta, platforms, Microsoft, NVIDIA, and Tesla. These Magnificent Seven had driven the biggest gains in the S&P 500 last year. The benchmark index has scaled all-time highs in 2024. We've seen it continue, but the performance of those mega caps has diverged more recently.
So you've Tesla, got, for example.
Well, right.
Down
We've talked about this.
29%, Carol, just since the start of the year.
Meantime, you've got AI darling NVIDIA at a record high, or has soared to a record high, and I believe
up 74% this year.
Yeah, and I think it's your top performer once again in the S&P 500. It was last year, and we've seen it atop the list again this year. Apple shares entered a technical correction. We talked about that with Abigail earlier. A technical correction entering that this month. Concerns about slumping iPhone sales and regulatory pressures. So that one's been under pressure as well.
Okay, let's go get to our Drive to the Close guest, Michael Sheldon, Executive Director at RDM Financial, joining us on the phone in Connecticut. Michael, good to have you with us. How are you?
Good. Thanks very much. A pleasure being with you.
Yeah, it's always good to have you with us. Hey, I wanted to I don't know if you had a chance to listen to what we were talking about the Magnificent Seven, but on the one hand, you have all these questions from people about whether or not we're in some sort of bubble, and then on the other hand, you have companies like JP Morgan coming out.
And Goldman Sachs that said valuations are below the tech bubble peak.
Yeah, coming out and saying that valuations are actually okay. How do you see things?
Well, there's definitely been some concentration among the top stocks in the market over the past, say, the year or so. And that kind of got turbocharged a little bit with all the excitement about artificial intelligence. So, I mean, artificial intelligence is definitely real. We're probably in the early stages of this. But I think if you look at the valuation, the market's come pretty far over a relatively short period of time since the October lows of last year. So if you look at the markets right now, we're trading at about 21 times forward earnings for the S&P, which is about 23% above its long-term average. But if you look beneath the surface a little bit, the median stock, so half are above and half are below, the median stock is only trading at about 14% above its long-term average. So a small number of stocks are trading at above-average valuations. Many times that's warranted by the growth they're producing, but they can get a little bit ahead of themselves. But there are stocks under the surface that are worth investigating.
And that's the point, right? If you broaden out and really look at the entire S&P 500 universe, you find out that there's a few that are skewing it once again in terms of valuations.
Yeah, that's a really good point. I mean, we've been looking for the market to broaden out for some time, and it really hasn't happened. So, I mean, if you take a step back, over the last 10 years or so, 10 plus years, which is a long time, growth has outperformed value, large has outperformed small, and the U.S. has outperformed foreign for much of the past 10 plus years. So a lot of people, ourselves included, we've been overweight those things, but on the surface, we've been waiting for other parts in the market to participate. So I'll tell you one other thing, that the RSP, which is the equal-weighted S&P 500, over the past few days, it hit a new all-time high.
Yeah, I was just going to ask about that.
But that's the first time in 544 days,
wow,
which is the third longest period since 1990.
So doesn't that tell you that it's broadening out now finally?
Yeah, I think over the past few weeks only, if you look at the S&P 500 versus the equal-weighted RSP, for example, over the past 1 week and over the past 1 month, the RSP equal-weighted index has outperformed the S&P 500. But it's kind of a little bit early to say that's the beginning of a real sea change just yet.
But it's good to see a broadening out, even the early signs of it, right?
Absolutely. Parts of the market we're getting somewhat overheated, and I think it's good to see broader participation. And really that would reflect that the market itself is doing better, the economy is reasonably well, people's forecast for profits going forward is more positive. So those are all positive things.
All right, broaden out, broaden out, broaden out. This is what we like to do. So the Russell 2000's up only not even quite 2% this year. How significant or how closely do you watch also what's going on with small caps, which are going to be probably much more closely tied to what goes on in the U.S. economy?
Yeah, that's a big part of the picture as well. So small caps, if they continue to rise, will really play catch up. And the question is, do you want to be in the market leaders, which are the large cap growth stocks, or do you want to play for a rebound? So we think you want to have some diversification, because again, if the RSP equal weighted is doing better, that means people are more optimistic. They're willing to sort of maybe get involved in some of the parts of the market that have lagged so far. So it's definitely too early to say that small caps have started to outperform. Mm-hmm. You also have to keep in mind, if you look at the Russell 2000, for example, more than 40% of those stocks are currently unprofitable. So you do have to be wary of that.
Hey, Michael, how due are we for a pullback right now?
I wouldn't be surprised to see some sort of pullback or correction over the next few weeks. The market's been up 16 of the last 19 weeks, for example. And if you look at things like sentiment surveys, for example, like the American Association of Individual Investors or Intelligence the investors' intelligence numbers, they're kind of frothy right now. So I wouldn't be surprised to see somewhat of a pullback or a correction over the next few weeks. But I think you have to keep your sort of eye on the ball. As long as the economy is doing reasonably well, people have jobs and they're spending, inflation is trending lower, which is important. It's not going to happen. It's not going to come down every month. And the earnings outlook continues to be positive. I think that will help the market over the intermediate term.
You mentioned inflation tomorrow, an important CPI report, another inflation print, which we know came in hot last time. How much of what comes, if it comes in hot again tomorrow, how much of what we're hearing from you today could change a little bit? And just got about 30 seconds.
Yeah, I think if the inflation numbers really come in higher, say 0.2 or more, I think that could be a short-term setback for interest rates and the markets. But some of that's already reflected in the market, the fact that that inflation is not coming down as quickly as expected. And you're seeing that in lower interest rates and a lower dollar over the past few weeks, I think.
All right, going to leave it there. Hey, listen, always appreciate it. Michael, take care. Have a great week. Michael Sheldon, Executive Director of RDM Financial Group, joining us on the phone here.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.